So today finance class is number 6, right? So I have given you exercises based on the balance sheet, income statement, and depreciation, right? So today, right now, our schedule would be like this. First, we do the practical exercises. We'll see the correct answers. Next, we move on the theory chapter about them. Here is accounting for limited companies. And after that, we move on the cash flow statement. We will review what is a cash flow, how it looks like, and how to prepare the cash flow statement. That's okay for you? So let's start from the exercise, from the homework assignments. I received some of your assignments. So let's see who done it right. So first exercise based on the income statement, right? So here is, the following items are listed in alphabetical order. Please prepare an income statement from this information. So we have some items like administrative expenses, administrative salaries, advertising, the amortization of goodwill, the consulting expenses, direct labor, and so on, right? And this is given for the 2010 years in USD currency, right? So here is the income statement just given to you in alphabetical order. So you should prepare the income statement in correct form, right? As you remember, in the previous classes, we have done some exercise based on income statement. So right now you have to be able to prepare the statement. So let's see what we have. Let's see the solution for this exercise. So here is solution for exercise number 1. So first, in the income statement, we should put the sales as the revenues, right? So let's see. We have a sales from the exercise number 1. Sales is equal to 100,000 in USD, right? Then we must deduct from the sales our cost of goods sold. Here is, first we put the sales. We have like a revenue, the cost of goods sold. We must deduct our cost like raw material expenses. We have 38,000 direct labor, the salaries for 14,000, the manufacturing overhead for 6,000, and manufacturing depreciation for 7,000, right? And total cost of goods sold would be 65,000, right? So as you remember, the income statement, the formula for income statement is the revenues minus expenses would be net income, right? So here is sales 100,000 minus 65,000 for our cost will show us the gross income, which is equal to 35,000. This gives us the gross income. Only gross income, not net income. Gross income is income before our administrative expenses, taxes, and dividends, right? So I'm sorry, some of you can't see the slides. Is it? Can you see the slide solution for exercise number 1, right? Oh, that's okay. So here is, we have a gross income is 35,000, and I am showing you the gross margin. The margin that it means here is the gross income. The income from our sales would be 35%. Yes. So this is shows that the gross income contains 35% from the sales, right? That's fine, this part, yes. So let's move to the next one. We have a selling, general, and the administrative expenses. So this is the administrative expenses. We have advertising, promotional expenses, the research and development. We always have some expense on research and development, right? In the lab and so on. The amortization of goodwill. The amortization, this is our the depreciation of the goodwill. Then some administrative salaries. We have administrative expenses, consulting expenses, other administrative expenses. This is all administrative expenses. It total will be 24,000, right? So here is we have earnings before interest and taxes would be 11,000. We deduct from the 35,000 minus 24,000 will give us the earnings before interest and taxes for 11,000, right? So the operating margin show us 11%. That means the operating margin contains 11% in the sales, in the revenues from the 100,000 sales, right? Then we must show our interest expenses. This is our dividends expenses. The dividends we pay to shareholders, right, is 3,000 from our list. And pre-tax income would be that 11,000 we deduct from 3,000 show us 8,000, right? Then we must show our taxes, how much we have it. Based on the list, before giving in alphabetical order, we have income taxes for 40%, right? So 8,000, and we must calculate 40% from the 8,000 from the pre-tax income. It will be the 3,200, right? And therefore the net income would be 4,800. This is a pre-tax income minus income taxes. 8,000 minus 3,200 will be the 4,800. So net income is the 4,800, and net margin is 4 and 8%. This is from the which is contained in the sales. So this is the ideal income statement. You must be prepared. You must you must be able to understand that we have a cost of goods sold and two different kinds of expenses. First is the operating expenses, the cost of goods sold. Then is administrative expenses will be different. So after sales, we must put the cost of goods sold. This is our operating expenses. Then we minus from the gross income the selling, general, and administrative expenses. After that, we deduct the taxes and dividends, our interest expenses. This is like how we must show in order. The first sales, then operating expenses, after that administrative expenses, after that shows earnings before interest and taxes, and interest expense itself, and taxes, and at the end of the income statement will give us the net income. The net income, which means the clearest income after all made expenses and costs. So this is the solution for exercise number 1. Any question related to this statement? Yeah, that's clear. I think you just getting your mind the orders of the items, how we must put first sales, then cost of goods sold. Just reminding your mind. Then gross income shows. After that, administrative expenses. Then interest and taxes. This is the order how we show the income statement. So I have some questions from Miss or Mr. Chohova. Sorry if I spell wrong. Yes, you can ask me. Just chat me, or if you want to talk, I can pass you microphone. Yeah, Mr. Akmal wants to talk. Just a moment. Pass you the microphone. Yes, Mr.
Can you
Akmal.
hear me, please?
Yes, I can hear you very clearly.
The calculation was clear up to earning before interest and taxes. But after this, the section, especially the operation margin and interest expenses, how you calculate the, when you deduct the 35,000 from 24,000, it's remaining 11,000, clear?
Yes.
And then how you attain 4,800, which make the 4.8%. This part was a little bit complicated. Could you please explain again?
Yes, okay, I can chat you. Just a moment. Here is, just a moment. So 11,000, we have the earnings before interest taxes. So minus interest expenses, which is 3,000, right? It gives us the 8,000. So first, here is just a moment. All participants. So this is a pre-tax income, right? Just a moment. Here is, let's see on the chart. So this is right, yes. Then we have a pre-income taxes 8,000, and we have an income taxes which is equal to 40%, right? So we must calculate the 8,000 to multiply for 40%. How we calculate the taxes? Right, this. Just a moment. This is income. Just a moment. Taxes. Here is 8,000 multiplied for 40% should be 3,200. And then we do like this. Pre-tax income, which is 8,000, we deduct it 3,200. It gives us 4,800, which is a net income. Like that. So I think this is understandable, right? Yes, right? So Mr. Akmal, he's agree with me. So if you know any question, we move on to exercise number 2, okay? Yes, right. So let's see the exercise number 2. So balance sheet preparation. The following items are listed in alphabetical order, same as the previous one. And please prepare the balance sheet from this information and then answer the additional questions. So first you must prepare the balance sheet first from these items. So we have accounts payable, accounts receivable, and so on, right? In USD currency. So this is a huge table, and it's continued on the next page, which is end with the wages payable, right? So let's see the solution for exercise number 2. Here is, I prepared for you the balance sheet, which is here is given us the current assets. As you remember, this is the first we must show our assets. First comes the current assets, then comes the fixed assets, right? The current assets here is we have cash, marketable securities, which is equal to cash, right? Do you remember I have given you the definition about what is the marketable securities? This is the special papers which is brought by the bank as a deposit, like it's same as the liquidity same with the cash, but cash is more highly liquidate. Then we comes with the accounts receivable, inventory, the current deferred tax asset, and other current assets. So here is total assets. Total current assets gives us the 58,700, right? So then we show our property, plant, and equipment, which is the fixed assets, right? The fixed assets which has the life more than in usage more than 1 year. Do you remember the long-term assets, which is first is land comes, then buildings, equipment, office equipment, and total gross of our assets will be 70,500, right? Then after that we must show our accumulated depreciation. Do you remember for the land, building, and for equipment, for the fixed assets, we have to depreciate them. And the accumulated depreciation, we will deduct it from our total gross, which is 34,500. And here is 70,500 minus 34,500 would be given total net property and plant, which is 36,000, right? After that, we show our goodwill. I hope you understand what is a goodwill. Goodwill is things like the patents, like some license, the brands, and so on. And after that, other long-term assets. And total assets would be 100,000. Here is the current assets plus total net property and plant plus goodwill plus other long-term assets give us the total assets, which is equal for 100,000, right? So let's see the next one. Let's see our liabilities and equity, what we have. So first we must show our current liabilities. We have accounts payable, right? This is our liabilities, the company's liabilities, accrued liabilities, the wages payable, the wages, the salaries payable, which means would be paid in the future. Taxes payable, same, which would be paid in the future but not paid yet. The current portion of long-term debt is like we have, for example, this is about if we have some the long-term loans, but we divided it into a small portion to pay for that. And when we pay the one part of these long-term debts, we must show them on the current liabilities. And here is the total current liabilities would be 31,500, right? So then we must show our long-term liabilities. It's like a long-term debts, the pension liability, the deferred taxes, and other long-term liabilities, which is equal the total one 74,500. And after long-term liabilities, we must show our stockholders or shareholders' equity, the capital, which is equal to capital worth. The capital, which is in the shareholders' investment, is 25,500, right? And total liabilities and equity is equal to 100,000, which is equal to total assets. So we have a balance between total assets and total liabilities and equity, right? So this is our balance sheet, is how we should to prepare it. So any question related to balance sheet? So I have some questions from Mr. Akmal, who is asking about to define which is the pension liabilities and deferred taxes. Sorry. So pension liabilities comes as long-term liabilities, because sometimes the pension liabilities we would pay not in we will pay more than 1 year. I mean, it's like given a loan which you can pay not in current year, you can leave it on the next year. So the payment which should be is not paid yet. So we will pay it for pension liability. It's exactly about like we prepare the balance sheet at the end of each year, right? And sometimes the pensions, the expense we pay on the next year, the first few months on the next year. It comes on the January or February or March. So in the first quarter. So if we haven't paid it yet, we put this like a liability, the pension liability. So what about deferred taxes? Same as this. For example, when I close my accounts in December, always is most in the cases the companies pay their taxes in January or February in the next year and in the next months. So, and actually you should pay it on the December at the end of the year, but most of companies pay on the next month on the next year before the quarters will be end. So as we haven't paid it yet for this year, we will pay in the future. So we show is like our liabilities and put in this row. In the liabilities and equities. So are you clear with these things? Here is, let's see, the wages like payable, the taxes payable, all those things haven't paid yet. So we will pay in the future, in the next month, or in the next 2 months maybe. If we haven't paid yet, it's our liabilities, right? We must pay it, but we haven't yet. So, and we put on the current or under the long-term liabilities. It's same with the accrued liability, same with the accrued liability, same comes. Is accrued liabilities is those liabilities which you haven't paid this year, and it automatically will be moved on the next year, and you show is as the accrued liabilities. For example, you already bought some products, right? In November, for example, in this, and you haven't get the cash payment for this product. You haven't paid for that, right? In December, you are going to close this, your accounts. I mean, to show your balance and income statement. And if you haven't paid yet, of course, you put as your accrued liabilities, which is would be moved on the next month. And then when you pay in the future, like say in the next month is January, February, or March, then it will be moved on the expenses on the next column. Here is on the under your assets or under your assets as expenses. So I have some question from Mr. Akos. He asking that he says that accrued liabilities must be under long-term liabilities. No, actually accrued liabilities could be two types. It could be current liabilities, like you pay during the 1 year, or could be as a long-term liabilities which you must be paid more than 1 year. I mean, you can pay after the 1 year. It depends on the types of your accrued liabilities. If you show on the current liabilities, it depends on the situation given. Here is just given, we put on the current liabilities because we don't know the time for payment of those liabilities, right? This is just in case of. So any questions to the balance sheet? I think this is clear also because we have done a few exercises based on the balance sheet. So, and I think you already have in mind the how to prepare the balance sheet. So is it okay for you? So let's move on the next exercise. So I'm going to move on the next exercise if not any questions. Okay. So here is, we have exercise number 2. We have some additional questions, you remember? So what dollar amount are the following items? You just must put the total amounts for current assets, gross plan, property, equipment, total assets, current liabilities, total liabilities, and total liabilities in the equity, right? And the question B, what items were not included on the balance sheet and why were they not included? So, sorry, I have some question from the Mr. Akmal, who's asking what is the goodwill. So let's see. We have a goodwill right here, right? This is goodwill. The goodwill is the thing which is have no material attachment, like the brands, like you have some special brand. For example, like Starbucks, they have a brand. Also, it is could be equal for some special amount, like your license. For example, you buy some license, like the audit or accountants, or in the forex company, in any kind of fields, you can buy some license, special license for your professional, right? This is a goodwill. The things which cannot be intangible things. The license, the brands, what say else? The trademarks and so on. So this is a goodwill, right? Okay. This goodwill is the brands, the service marks, the trademarks, for example, like a license and so on. This is a goodwill. Intangible assets, intangible. So I think you're clear with these things. So let's move to the next one. So here is, we have some additional questions. The A, what dollar amount are the following items? Because we have already did the balance sheet, and you must just put the correct amount. Here is, and the question B, what items were not included on the balance sheet? So you must think about that some items is not included in the balance sheet and why they are not included. So let's see the answer. So here is the answer for A, for question A. So current assets is 58,700. Let's move. Let's back on our balance sheet. So here is total current assets 58,700. Right? This is the right. The gross plant, property, and equipment. So gross plant, property, and equipment is 70,500. Right? So let's back on the balance sheet. Here is total gross. This is the one. Total gross PP&E, property, plant, and equipment is 70,500, right? And total assets, which is equal 100,000, right? The current liabilities is 31,500. Here is, let's back. Yes, right. Total current liabilities is 31,500. Yes, right. And then we have a total liabilities, which is equal to 74,500, right? Let's back. Here is, let's see. Yes, right. Total liabilities is 74,500. And which is the total liability with equity, which is equal to 100,000, right? So I think you are clear with exercise number 2 for question A. This is a simple one. So let's move to the next one. So the question B for exercise number 2. What items were not included on the balance sheet? We have two kinds of items, which is the first net income, the second one depreciation expense. So net income. The net income is the bottom line of the income statement, right? And it's reflected on the income statement. And indirectly net income is captured in the stockholders' equity. So let's back on our questions. Here is, you remember in the exercise, the assignment, here is given the net income, which is equal to 7,200. So we shouldn't put it on the balance sheet because the net income is a part of the income statement. So the different statement. And the income statement is already, this amount is already inside the stockholders' equity. The next one, we haven't put the depreciation expenses, right? Here is, let's see, this one. Depreciation expenses, which is equal to 7,000, right? We shouldn't put it on the balance sheet because we already have accumulated depreciation, which is equal to 34,500. What that means? Accumulated, which means the total depreciation, for all of the fixed assets. So, and that means the depreciation expenses for 7,000 is already inside the accumulated depreciation, already included here. So, and if it's like this, we wouldn't put it on the balance sheet because this amount is already inside this amount. If you can see what I have done actually. So, hello, can you hear me? Because some of you can't hear me. Yes, yeah, you can hear me. Yes, okay. So, don't sleep, please listen. So, depreciation expense is already inside the accumulated depreciation, and you shouldn't put it on the balance sheet, right? So, and here is the answers for the exercise number 2B. First, we haven't put the items like net income and the depreciation expense. Is an annual expense. It's indirectly captured on the balance sheet as an increase in accumulated depreciation, which means it's already inside the accumulated depreciation. So this is the answer for the exercise number 2. Because I think you're clearly with these answers, because I haven't received any answer from the students about this question. So you remember, because in the future, when I give you some assignments, I give like this assignment, which would be confused. You must think which kind of items you should put on the income statement, or you shouldn't. Which kind of items you put on the balance sheet, or you shouldn't put it. You must recognize the items for the balance sheet with a separate to the income statement. Okay? So, okay, that's fine, yes? So let's move to the next one. So we have exercise number 3 based on depreciation, right? Let's see. So Cascade Company has a quarterly accounting period. On the 22nd of March 2002, Cascade acquired a computer for 12,000 in USD currency. The management estimates the useful life to be 3 years. And at the end of 3 years, the computer will have no resale value. Right? This is very important. That means at the end of 3 years, the computer will have no resale value. First question, they assign for you. Using straight line depreciation, compute the depreciation expense for the quarters which is ended 31st of March, the 30th of, which is the 6th is June, and the 30th of September, right? The 3 quarters given to you. And the question number B, questions for B is why does Cascade Company need to record the depreciation on this computer? So here is giving you assignment, just simple one. The company acquired, which is mean the bought the computer for 12,000 and going to use it for 3 years only. And you must use the straight line to depreciate it for 3 quarters, not by each year, but for 3 quarters. You remember the 1 quarter is, we have in the 1 year, we have 4 quarters, right? 4 quarters. 1 quarter, quarter is equal to 3 months, right? This very important. 1 year is equal to 4 quarters. The 1 year contains 4 quarters, and each quarter contains the 3 months, right? So here is solution for exercise number 3. Let's see. First, we calculate the depreciation for each year. The 12,000 divided for 3 years would be 4,000. So we have a 4,000 depreciation in each year. The 4,000 we divide on the 4 quarters, because in the year we have 4 quarters. It would be 1,000 depreciation in the 1 quarter, right? And to calculate how much depreciation we have in months, the 1,000 we divide on the 3 months. We have a depreciation 333 with little amounts around in the 1 month, right? And now we should calculate the depreciation for each day. How many depreciation we have in 1 day? Why we do this one? We calculate for each year, for each day, sorry. Because you remember, let's back on the exercise. We bought the computer on 22nd of March, right? 22nd of March. And the assignment given that we must calculate the depreciation on the 21st of March. So here we have a difference 10 days. That means first we have to calculate depreciation for 10 days for first quarter, right? For first assignment. So here is why we have, I'm given to you that we the depreciation in the 1 month we divide on the 31 days, which we have a 31 days in the March, and we can get the depreciation in 1 day. We have around 11 USD, right? Then we must calculate that how many days we have from 22nd of March to 31 for the 31st of March. We have 10 days, right? From the 22nd include the 31st. We have 10 days, right? And here is the depreciation in 1 day, which is equal to 10 and 75. We multiply for 10 days, and now we get the depreciation for 10 days is 107.5, right? So, and just now I have shown you the cost. Here is given on the 21st of March, depreciation will be 107.5 USD. So here is first we show the total amount, which is 12,000, and then we show the depreciation which we calculated on the 21st of March, right? So we deduct the 107 from 8,000, we will get 11,892.5, right? Then we will deduct 1,000. Why? Because the 30th of the 6 months is which is June, right? June. From the March to June we have 3 months, right? Here, let's see. On the in the 1 quarter, which is equal to 3 months, is equal to 1,000 for 1,000 USD depreciation. And we deduct from the 11,000 1,000, right? The next one we have the another quarters is which is ends on the 30th of September. Same things. From the June, between the June and September, we have 3 months, which is equal to 1 quarter, and we must deduct 1,000 from the balance we get from the depreciation before the previous quarters, which is equal to 10,000, right? And at the end of we have the amount for our computer, which is equals for 9,892 and 5, right? So there is the solution for exercise number 3. How we do calculate the straight line depreciation, right? So this is based on the straight line, you know that. But here is, you must remember, of course, we should we must be let's see, we must be very carefully look at the assignment, because the assignment given that we must calculate for the next quarters, which is the March, June, and September. Besides of that, we are going to use the computer for 3 years. Yes. So here is the answers for you. So any questions? So I have some questions. Sorry. Why we calculate such small portion of depreciation? Why only for quarters? This is I have some questions from Mr. Akmal asking why we calculate the depreciation for quarters. Because the assignment is given to you to calculate by quarters. It depends on the company. For example, the Cascade company is calculating its depreciation quarterly. Some of companies can calculate the depreciation yearly, each year, yearly. This is calculated by quarterly. Depends on the company that using the methods for calculating, and depends on the country where is the taxes, how depends on the taxes rules. Some of countries pay the taxes each year. Some of countries pay the taxes. In the countries, the company pay taxes quarterly. Some of each year. Depends on the country you're working in, and depends on the company are using the methods to depreciate its assets. Okay, so you can, for example, I can say you like in Malaysia, when I run the business, I pay taxes and I prepare the income statement each year at the end of December. So in the Malaysia, the taxes payable each year. But example, as in besides of in other countries like Russia and Kazakhstan, in my country, we pay taxes quarterly, each 3 months. We must pay the taxes. It's like at the March, the next 3 months we pay each 3 months our taxes. We must pay. This is by the government rules, like this. I think I'm not sure in Afghanistan how you do pay taxes. What the period for taxes you have? Anybody knows how the companies pay taxes each year, or quarterly, or maybe monthly pay? So Miss Masuda says monthly. Monthly. Some says the per year. No, salaries. Some of you says like salaries paid each month. Salaries is not taxes. Salaries is your operating expenses. Of course, the salaries you pay must pay monthly, but taxes, which is based on your incomes, is usually paid each year. but like countries like Russia, Kazakhstan in Europe, they pay the taxes yearly, or quarterly, sorry, quarterly, each 3 months. So okay, that's fine, yeah. So let's see the next exercise. So the exercise number 3, the second one, is also based on the depreciation, right? So let's see. Of course, some of you asking, send these solutions. We'll send you later after class. So let's look at the exercise number 3, the second one, this depreciation, which is based on the depreciation. So here is just a moment. The richest enterprise maintains its fixed assets at cost, which means the original cost and depreciation are shown as separate entities in the balance sheet. We always actually show our the original cost of the fixed asset and depreciation separate, right? The same with the richest enterprises. A depreciation provision account is in use for each type of assets. So what does that mean? The depreciation provision account is in use for each type of assets. That means company is using 2 kinds of methods to depreciate its assets, which is the first reducing balance method and straight line method. For each type of the fixed assets, it's used different methods. For example, for motor vehicles are to be depreciated at a rate of 12.5% per annum on a reducing balance method. So motor vehicles is being calculated by the reducing balance method. The next one, the office equipment, is to be depreciated using the straight line method. You see, for the different types, it would use the different methods. In the year of sale, the depreciation is to be calculated according to the number of months owned. Accounts are prepared annually on the 31st December each year, right? The following transactions in assets have taken place. So, 1997 year, the 3rd of January, they purchased new motor vehicle by check at a cost of 21,000. 1997 March, purchased new office equipment costing 12,500 paid by check, right? And at 2030 of September, sold motor vehicle for 10,500, which is received by cash. So here is the sign. Calculate the depreciation charges for the motor vehicle and the office equipment for each year from the 1997 to 2000, right? Which is given to you like 97, 98 for 4 years. You must calculate the depreciation for 4 years from 97 to 2000. So the business plans to use the office equipment for 8 years, and it's estimated that at the end of that time it will have a salvage value of 500. All depreciation charges should be rounded to the nearest pound. So here is given assignments which is include 2 kinds of assets, which is the first motor vehicle calculated by the reducing balance method, and second one is the office equipment, which is calculated by straight line method, right? So you do calculation with the 2 types of assets, with the 2 kinds of methods, with the different methods, you must remember. So here is So let's see the solution for this exercise number 3. I think most of you have been confused with this exercise because I haven't given some answers. Some of you done only. So let's see the solution 1. So the solution for exercise number 3.2. So motor vehicle which is cost 21,000, right? We calculate it by the straight line method. This is a reducing method. By the reducing balance method, which is we given and given the percentage for this 12.5, right? So we must to calculate for 4 years, right? For 1997, the depreciation would be 2,625. That we get with the 21,000 multiplied for 12.5% would be 2,625, right? Then we calculate the next year, which is the 1998, right? We deduct the 21,000 minus 2,625, we get the 18,375, right? Then from this amount, we calculate the depreciation, which is the rate at 12.5. And we will get the answer for 2,297, which is the depreciation cost. Right? After that, we got the deduction from 18,000 minus 2,297. We get the 16,078, right? Then we do the same things with the next year, 1999, right? After that, you see here is the last year for 2000. We the calculated depreciation for 9 months only, not for full year. Why? Let's back on the question. Why? Because here is in the assignment given us that on the 31st of September we sold that motor vehicle for 10,500, which is received by cash. In the September we have been sold this the motor vehicle. So that means we must calculate depreciation for 9 months only, because after that we already sold this motor vehicle. We already get some the salvage value, some cash from this motor vehicle. So, and the answer will be the balance of these motor vehicles equal to 12,749. So, any questions related to motor vehicles first? Any questions? Why we do? So we should calculate the depreciation for 4 years. But at the 4th year, at the last year, of the September, we have been sold this motor vehicle, and we do calculation for 9 months only, because after that we are not going to use this motor vehicle because it's already sold, right? So no any question relates to motor vehicles depreciation? Yes, and Ms. Masuda says that 3 months would be not included in the depreciation, right? The October, November, and December, which is the 3 months, which is not included in depreciation because we are not using this motor vehicle. It's already have been sold, going away from the company, no anymore in the company. If it's not anymore in the company, why we should to calculate the depreciation? No, we shouldn't. Of course, we shouldn't. So this is the answer for the motor vehicle. Yeah, clear. Yes, right. So let's move to the next asset, which is the office equipment. Let's see. You remember the office equipment is should be depreciated by straight line method, right? And in the sign is given that is going to be used over for 8 years, and at the end of the 8 years, after 8 years, it has some value for 500 only. This is very important. Let's see. First, for this box, let's see the gray box. Here is given the depreciation to be calculated over 8 years based on the purchase cost, salvage cost. That means we have first we bought the office equipment for 12,500, right? Here is, I'm going to show you. This 1997 March 8, we purchased new office equipment costing at 12,500, right? This is the costing of the equipment, right? And minus 500, which is salvage value. We have some value at the end of usage. We must hit minus and divide for 8 years. And then we will get the depreciation for each year, which is equal 1,500. So this is, I think this box is clear, yes? How we should to calculate. First, we will get the costing, 12,500 minus salvage value, and divide for 8 years. And we will get depreciation for each year, which is equal 1,500. The salvage value, which means this is the value of the any assets have been used. I mean, you have some. Let's see. It's like you repair some fixed assets, and you have expenses like the repair expenses. This is the salvage value. Like you have some balance at the end of usage of these kind of assets. Salvage value, here is, I have some questions. Why given the salvage value for 500? In the assignment is given to you that this kind of equipment will have some salvage value. It's based on the homework assignments, based on the exercises. Sometimes it could be given you salvage value that you must to deduct it from the costing. Sometimes it won't be given to you. This is the repairment expenses given to you. That at the end of usage of the 8 years by the office equipment, you have some value of this office equipment for 500. You can, for example, after 8 years, the use of office equipment, you can like resell this equipment and get like some value, some cash, like for 500. This is the means that after 8 years, maybe you, after the usage of any equipment, any assets, you can resell it, for example. And you can get some kind of money. Like, for example, I bought the computer. I use it 3 years. Like, I buy the computer for 2,000 USD, right? And I can use it 3 years. After 3 years, the lifetime of this computer is already going to be end. I already depreciated it, but I can resell it on the market for repairs, for somebody for repairs. You know that we have some the repair store. You can resell this kind of computer and get some cash money. And this is the salvage value, that you can get some cash money from the resale of this kind of equipment, for example. So how do you understand? I think I would I try to explain to you as much as I can. So 500 is the salvage value, and the 1,500 is the depreciation. So this is two different things. So you see, after the we have calculated the depreciation, which is equal to 1,500, and based on the straight line method, we must show how we do calculation for depreciation. 12,500 minus depreciation, which is equal to 1,500, and we will get the 11,000 balance for this equipment. And minus depreciation for 1998 for next year, we will get 9,500, right? Balance for the equipment. Then we calculate the depreciation for 1999 for the third year, which is same equal to 1,500. So at the end of usage of 4 years, we have 97, 98, 99, and 2000. We have a balance of the for office equipment, which is equal for 6,500, right? So we have done our assignment. So you must remember, first, how you do calculation. For the straight line method, you check the costing of the assets and divide for the years, for how many years you're going to use your assets. For lifetime of the assets, here is given like 8 years. But before that, before divide for 8 years, we should to deduct it from the salvage value, which is given 500. That means at the usage after the 8 years, we have some value of this office equipment, which we can get by the cash for 500. Like I can resell it and get some money from this office equipment, and this comes like some kind of benefit from this office equipment. So I think you are clear with the office equipment depreciation. So we have looked at the two kinds of depreciation methods: the motor vehicles by reducing balance method, and the office equipment which use a straight line method, right? So any questions? Any questions related to the homework assignments? So this is the last exercise. Yeah, right. That was the last exercise. No questions? Yes? It's clearly. So you try to remind, to get in your mind the solution for these exercises, because on the exam I will give you not the same, but mostly which is mostly seems like this, mostly looks for these exercises. Just a moment. So your let's say your exam assignments will be similar for these exercises, for depreciation, for balance sheet, and for the income statement. Would be similar, but with of course a different kind of assignments maybe, and different kind of items given in figures. And you must try to review these homework assignments after this class again, to understand it more clearly and get in your mind. So that's all for exercise, for practical exercises for today. Let's move on the theory chapter, okay? So not any questions. I'm going to move on the chapter 4, which is the chapter 4, accounting for limited companies. Let's see what we have. So here is the topic and structure of the lesson. We have a nature of limited companies. We will look at the main features of the owner's claim in a limited company, the statutory and non-statutory rules, that surround the accounting for limited companies, the profit and loss account, and the balance sheet of limited companies. Actually, we already looked at the profit and loss account, which is the income statement, and the balance sheet of the limited companies, right? We already have some exercise. We know what is these things. Yes, we will give you remind little things. So, gaiters, you must be able to use the limited company, shares, limited liability, directors, public company, private company, reserves, nominal value, the dividends, equity, preference shares, capital reserve, share premium, bonds issue, rights issue, debenture, creative accounting, right? So let's see. Then what is the main features of limited company? What is a limited company? It's an atypical person that has been created by law. It has separate life to its owners and is granted a repressial existence. A repressial, which means for no time, for long term. It must take responsibility for its own debts and losses, but its owners are granted limited liability. It's governed by a board of directors. Yes, right? The companies, they are mostly governed by the board of directors. And public company can offer its shares for sale to the public or the private company. And for the public, and the private company cannot. We have two kinds of companies, which is the private ones and the public ones. The share, what's financing the limited company? The share capital of company can be of the two main types. You remember we already looked at the ordinary shares and on the preference shares, right? Just to remind you that ordinary shares are the main risk takers and given the voting rights, and for the preference shares given right to a fixed dividend before ordinary shareholders receive a dividend. Just given the fixed dividend but no voting rights. So it means that any limited company can issue two kinds of shares, which is ordinary and preference. And they have different terms and conditions. Ordinary, which is the voting rights, the people have a voting rights who have ordinary shares, means that can decide some businesses in the company, can get some let's say get some proposals and to decide how to run the businesses. But preference shares holders, they have no this kind of rights. And also they have a different kind of dividends. The preference shares, they have fixed dividends each year. For example, maybe 20% of the dividends they get each year. But for the ordinary shares, it depends on the revenue, on the income the company gets. If the company has some positive income this year, they can pay the shares for the ordinary shares holders. If they have no any income, they won't pay the dividends for ordinary shares holders. But besides of the preference shares, which is the holders always get the fixed dividends each year. No, which is not depends on the incomes which is a company have each year. So this is two kinds of, we have ordinary shares. Let's see the next one. So also the company can be financed by the reserves, which is the profits and gains made by the company and form part of the ordinary shareholders' plan. And loan capitals provide another major source of finance. You know that we have some reserves in the company, we have some loan capitals, which all the company can be financed. The next one, so what is, we have some share issues. The bonus shares are issued to existing shareholders when part of the reserves of the company are converted into share capital. And the right shares gives the existing shareholders the right to buy new shares in proportion to the existing holdings. And the share of public companies may be bought and sold on the recognized stock exchange. I think these things is clear. You know those that stock exchange. We have some stock exchange. some public companies, they sell the shares in the stock exchange, right? So we have some kind of reserves, which is two types, the revenue reserves and the capital reserves. What is this? The revenue reserves arise from the trading and profit and from realized profit on the sales of fixed assets. So revenue, they realize from the revenue. And the capital reserves arise from the issue of shares about their nominal value or from the upward revaluation of fixed assets. Capital reserves arise from the shares, which means any company can issue the shares and sell them. And the margin between the nominal value and the sale value, it gives us the capital reserves, right? Just wanna give you some formula. Nominal value so sale value of the shares minus nominal value of the shares equal to the capital reserves. Capital reserves. Here is. This is just formula given to you based on this explanation. On the explanation by the capital reserves. What is this? The sale value of the shares minus nominal value of the shares give us the capital reserves, right? So let's see the next slide. We have what is financial statements of limited company. You know already the financial statements of the limited company is a three kinds of types: the income statement, balance sheet, and the cash flow statement. We already know what is the income statement. We already know what is the balance sheet, but we haven't go the cash flow statement. We will look after this chapter. So the financial statement of limited companies are based on the same principle as those of the sole proprietorship businesses, right? However, there are some difference in detail. The profit and loss account, which is the income statement, has the four measures of profit displayed. First is the operating profit we show, then net profit before tax, net profit after tax, and unappropriated profit. These things you know. In that income statement we show this is four kinds of profits, right? Let's see the next one. So the profit and loss account also shows the audit fees, transfer and reserves, corporate tax for the year, and dividend for the year. The balance sheet refers to current liabilities as creditors, and long term, in which is current. This is things you know. What is the balance sheet and the income statement? Just given to you another kind of definition. Let's move the next one. The share capital plus the reserves will be shown as the owner's claim, right? These things. What kind of we have rules which surround the limited company? Let's see. So here the directors are legally obliged to keep the proper account records and to prepare the financial statements. That means all the companies, the directors must prepare the financial statements, right? Which is income statement, balance sheet, and cash flow statement. The law requires that the financial statements show a true fair view. This is very important. You must show fair view of your companies in the statements. And the account standards have been developed by the UK account profession to define what is meant by a true fair view. This is based on the UK accounting. The companies that are listed on the stock exchange are subject to additional rules to those imposed by the law and account standards. So these are appointed to provide an independent opinion as to whether the financial statements show a true and fair view. That means the auditors, they monitor and control the financial statements of the company. They are recognized that is true, that the company given you true and fair view statements or no. Yes. And this, we have some, you know that we have internal auditors and external auditors. External auditors like Ernst and Young and so on. The external companies, despite the accounting rules that are in the place, there have been recent examples of creative accounting by directors of companies. Yes, that means that some companies use the creative accounting. It depends on the various business that companies work, but actually by the government rule, all the forms must be prepared by the trade bureau and must be prepared by the rules given in that particular country. I know that you know that each country has its own kind of the forms, the preparation of the statements, like financial statements. And we have some international rules to prepare the financial statements. So it depends on the countries how they do prepare, and depends on the professional area. I mean the areas of the businesses. So that's all. This is just was a little explanation of the limited companies in the chapter 4. So let's move. That was a little theory about the accounting in the limited companies. I think that all was clear. Let's move to the cash flow statement. So you must remember. So in the company have three kinds of financial statements. Yes, right? First, income statement. We already know what is income statement, how to prepare it. We have done some practical exercises. Second one is a balance sheet. We already done some practical exercises, right? And the third one is the cash flow statement. So let's look what is a cash flow statement and how to prepare it. So introduction, here is the complete descriptions of the company's financial activities during a year consists of the three basic financial statements, as I already told you. That first is an income statement shows the activities as measured by the revenues or sales and expenses of the firm throughout the period. That means the income statement will show us the company's revenues and expenses, right? A second is the balance sheet, provides a snapshot of what the firm owns and what the firm owes at specific time. That means what kind of assets company has and what kind of liabilities company has. And the statement of cash flows is lists the sources and uses of cash that results throughout the period. The statement of cash flow describes the underlying transactions that cause the cash and cash equivalents from the balance sheet to change over time. Let's see more in detail on the cash flow definition. The cash flow statement is a statement or report, we call it, of flows both in and out of the business of cash. This is a statement, I just want to explain to you in my own words. This is a statement which shows us the cash, where they go out and where from that they come in our company. So it's usually measured during a specified period of time. We use it in a specific time, for example, each year. Remember that the cash flow statement shows flows of cash only, not income and expenses. Only cash, how much we receive, how much we spend, only cash, not all the payable and receivables. Like you remember, we have some accounts payable, some accounts receivables, there's some money which we haven't get yet, which we haven't paid yet out. But here is in the cash flow statement, we show only that cash we already paid, that cash we already received, okay? So measurement of cash flow can be used for calculating other parameters that give information on the company's value and situation. So It means that the cash flow statement also gives us some kind of picture of the company. The situation of the company is, so here the cash flow can be used, for example, for calculating like this. What kind of parameters? First, to determine a project's rate of return or value. The time of cash flows into and out of projects are used as inputs in financial models such as internal rate of return and the net present value. About these parameters, we will study on the next session. To determine the problem with the business liquidity, you know the liquidity is the fastest turn in the cash, how fast the assets can be turned into cash. The being profitable does not necessarily mean being liquid, right? A company can fail because of a shortage of cash even while profitable. It means like you are a profitable company, so you have some positive income in your statements. But it can be given if you have no cash in your accounts. It not means that you are a liquid company. That it also gives some picture, for example, for your banks. Like you are going to get some loans, okay? And you show your cash flow statement to the banker. And he can see, okay, based on income statement, you are profitable company. You have a positive income. But based on your cash flow statement, you have no enough cash in your accounts. That means if you have some liability, like force majeure situation, you can't pay for your liabilities. Maybe you can't pay for your the bank expenses, like the interest expenses for the bank, for example. And it gives to the bankers the bad picture of your company, okay? And the banker can be think to give you loans or not. What I mean, maybe to increase for you the rates or not. This is also important. The cash flow statement, when you are going to get some loans or credits, or you are going to get some financial outside. Okay? So let's see the next one. As an alternative measure of the business profits, when it's believed that accrual accounting concepts do not represent economic realities. For example, a company may be nationally profitable, but generate little operational cash, as may be the case for a company that barters its product rather than selling for cash. In such a case, the company may be deriving additional operating cash by issuing shares or raising additional debts. It means the same. Company is profitable, but have no enough cash in the accounts. So in this case, to operate in the future, maybe company needs to issue additional shares to get the cash in the accounts. Okay? So do you understand the example for 3? That when you have no cash, but you are profitable, but you have no cash, what you can do? You can issue additional shares to get the cash in your accounts. Okay? So I have some questions. Give the example for first and second one. The second one is same as I told you. The liquidity. That means the company is profitable, okay, but now have no cash at the accounts. In this situation, if it's like you have some special situation, like force majeure situation, you must pay some your liabilities. You must return some your payments very quickly. But in this stage, you have no cash in your accounts. That means you are not liquid. You're not liquid company. You have no enough cash to make your payments, and this is give like a negative your negative picture of your company to the others, to the outside, to the other companies, markets, or bankers, or your like partners, for example. This is example for the second one. The first one, so here is given that to determine a project's rate of return of value. The time of cash flows into and out of the project is used as inputs in financial models such as internal rate of return. That means when you're like a company, you do some, for example, you do some investments, you have some new projects, right? And for this investment, you must invest some cash money. And here is the cash flow statement show us how much cash we have been invested in this kind of project and how much money we get as income from that project. This is example. The cash flow statement shows us the rate of return, how much we spend for special project, how much we spend the money, cash in cash, I mean, and how much we get in the income, how much we return the money from this kind of from a specific project. Okay, so let's see another 4. The cash flow can be used to evaluate the quality of the income generated by accrual accounting. When the net income is composed of large non-cash items, is considered low quality. What that means? That means you have positive net income, you have profit, right? But this profit is in the non-cash items. Maybe it's like accounts receivables, like some like debts, you should receive it. And of course, this shows that your low quality of your company. Why low quality? Low quality means low quality of your the company's situation, company's position, financial position. For example, I would like to be your partner in the business. You would like to buy, you're going to buy from me some products, and I can request you to give me your cash flow statement. And based on the, for example, income statement, you have some positive income, that you are profitable company. That gives me the note that you are a good partner. For example, you are profitable. That means you can pay, you can make a payment in specified date. Yes, you are profitable. Your financial position is a good one. You can pay for. You can make a payment for my products at the time I tell you, like during 3 days, or another one. Let's get another current one. But when I see your cash flow statement, I can see that you have no cash. You have no enough cash in your accounts. That means you can make a payment. You can make a payment for my products later. So if you do like this, I mean, if you are not paying in specific time, you will get the latest payment, and the latest payment for me for my products is not profitable for me. It's not suitable for me, because I need, for example, I need the cash in that time that I require you to pay for me. And if your cash flow statement is negative, that means you have not enough cash in your accounts. That gives me your picture that you are not a liquidity company, and you have a low quality in the cash payments. And in this situation, maybe I will think as a partner to work with you or not, to supply for your products or not. Okay, this is an example for the low quality. The next one, to evaluate the risk within a financial product. The matching cash requirement, evaluating default risk, the reinvestment requirement. The same things. If your cash flow statement is a negative, you have no cash account, you have not enough cash in your accounts, that means you cannot do your new investment in the future, okay? If you have no cash in the banks, you cannot reinvest your money. You must receive it first, then you will reinvest. Also, cash flow statement shows this kind of picture for the reinvestments. Can you do reinvestment if you have enough cash money in accounts, or you can't do it? So the cash flow statement is very important when you do some investments, when you would like to get some new partners, or when and also when you would like to get some loans from the banks. Here the cash flow statements are very important statement, because it shows a clear picture of your the company's liquidity and the company's qualities. Okay. So here is, let's see the next slide. The total net cash flow sorry, is a sum of cash flow that are classified in 3 areas. So we have a cash, we can get the cash from 3 kinds of areas. First is operational cash flows, which is the cash received or expended as a result of the company's internal business activities. It includes cash earnings plus changes to working capital. Over the medium term, this must be net positive if the company is to remain solvent. So operational cash flows, that means it shows the cash flows from our main businesses. For example, what we do, we sell some products, or we are making some products, if you are fabrics and factors. Another one, we have investment cash flows. The cash received from the sale of long life assets or spent on capital expenditure, the investment, acquisition, and the long life assets. That means the cash flow from the investment, this is same when we do some investment in some projects. And we have some financial cash flows, the cash received from the issue of the debt and equity, or paid out as dividends and share repurchase and debt payments. This is financial cash flows when, for example, we issue additional shares. This is a cash, or this is show us how much we cash in and out comes, the flows of the cash ins and outs. So let's see how you can hear me. Some of you can't hear me. Okay, some of you asking me to give some example for these items, for 3 items, which is the operation cash flow, investment cash flow, and financial. Okay, first, operation cash flow. This is the cash which we receive or invest on our main businesses, or our main operation. For example, I am travel agency. This, when I buy some tickets, I book some hotels, buy some rooms in the hotel. This is cash comes in and out. This is operational cash. The main business, my travel, when I buy tickets, book some hotels, rooms, and so on. This is the operational cash flow. The investment cash flow, like when I invest my money for some long-term projects. For example, in the different kinds of business, I have some kind of projects. Maybe like it also could be, for example, the investment cash flow. It also can be like MBA. Some companies pay for MBA, right? They have, and this is also investment for the staff, right? And cash that paid for MBA expenses. This is the investment cash flows that goes in and out. Out means when we receive cash from investment, it means when you are like a staff, you got already some MBA, you have some, you acquire some knowledge and experience, and you do some good proposal or ideas for your company, and it brings the money for the company, it brings the profit, and this is the cash which comes from the investment. Okay, and the financial cash flow, it's example, as I told you, when the company needs additional cash, they can issue shares, additional shares, and the money comes from these shares is a financial cash flows. So let's see, we have an example of the cash flow statement. So the example number 1 is a simple example of the cash flow. Here is cash flow from operations. Is the sales, as I told you, is the cash flow from the main business, sales. We got plus 30. That means we have a cash in for which is equal for 30. We have a cost, materials, minus 10. We deducted 10. We have a labor, which is the expenses. We paid it for our staff $10, which would be deducted from the sales. And the total cash flow from the operation is 10 positive, right? Because 30 minus 10, 20 minus 10, it gives us the 10, right? This is a simple by mathematics. So let's see the cash flow from the financing. So we have some incoming loan. Loan we get from the bank plus 50, right? We got cash in our accounts means. Loan repayment, we must pay some interest expenses based on these loans. The cash goes out, minus 5, goes out from the accounts, right? And we pay some taxes, the taxes. Minus 5, we pay taxes. The cash goes out. And the total cash flow from finance would be positive 40, right? 50 minus 5 and minus 5, right? Let's see the cash flow from the investment. Purchase capital. We have purchased some capital. The cash comes out, minus 10. We purchase a capital in, that means we purchase a capital in a different company. We invested some money to different kind of company. That means the cash money goes out from the company, minus 10, right? So description gives us the 3 kinds of areas of the cash flow, and total will be, here is 40 positive. We have $40 positive our cash. In our accounts we have $40. Means this is simple. We have in our accounts cash which is equal to $40. Okay, this example is simple one. So just will explain to you how we show the cash flow. So some of you ask me how we can recognize that the positive or negative the item. Okay, let's see. Sales first. What is the sales actually? This is a revenue. Sales means when you sell some products and you get some money. Okay. Of course, this money can be in cash. You receive in cash, and cash comes in the company. So it's positive, right? Because cash comes into company in the account plus positive. Like materials and labors expenses minus because we pay for that. We pay for stuff and we pay by the cash and money goes out. Okay? That means it's negative. We show as a negative because this expenses goes out. Okay? And same with the incoming loan. This we get some credit from the banks. The money comes into our accounts from the banks as a cash. So our cash increase for 50, right? But when we pay taxes and the interest for loans, the money goes out. Okay? It goes out. We pay. This is shows us the negative one. Okay? And like investment, which is the purchase capital. When you do some investment, okay, I have some money, okay, I want to pay to my staff for MBA. How much is 5,000? Yes, and I get some cash from my accounts and pay for VVS administration, and the money goes out, right? This is the cash flow statement. We show the flows of the cash in, coming into our accounts, and out, which is the payments, which is expenses and investments. Okay. When positive, we have it's about when we receive the money as a sales, as some investments, as some loans, credits like this. We receive money in the cash. And the negative is of the cash is when we pay for expenses, labor, materials, advertisements, costs, any costs, and when we do investment out of the company. Okay, this is about the cash flow statement. So this is was example, very simple example. Let's see the example number 2, which is gives us the more clearly picture of the cash flows of any companies. Just example, cash flow statement for XYZ businesses for the year ended 31st of December 2010. Okay, let's see what we have. First, cash flow from the operating activities. You remember operational cash flow. So we sorry. We receive the cash received from customers, right? 83 plus. With cash paid to suppliers and employees, minus 56, right? And cash generated from the operations, and it is equal to 27,000. Okay, clear? Okay, let's move. The next one, dividends we received. We received some money. Positive 250 cash in, interest received 500 cash in, the interest paid we paid, that means cash out, minus 500, tax paid we paid, the cash goes out 2,450, and net cash flow from operating expenses is 24,800. Okay, this clear? Yes. The next one, the cash from the investment activities. Some additions to equipment. Additions to equipment, cash goes out. That means we make some expenses for repayment of our equipment. We pay for repayment. The cash goes out, 2,500. Okay. The replacement of equipment. We buy some equipment. Okay, we replace that equipment, we buy some new equipment. The cash goes out, minus 7,000, right? Another one, the proceeds from sale of equipment. Proceeds means when we resell some equipment, we got some value for 500 plus. And the net cash flow from investing activities will be negative 9,000, okay? So you remember from the operating activities we have a 24,800 positive, but from investing activities we have a negative amount for 9,000, right? Let's see the cash flow from the financial activities. So the proceeds from capital contributed. We have get some dividends for 3,400. The proceeds from loan, we get some loan for 16,000, cash in, positive, okay? The payment of loan, we pay for loan, we pay to banks, cash goes out. Our expenses is negative 5,400. And the net cash flow from financial activities will be positive 13,000, okay? And in the next one, see, we have a net increase or decrease in cash. Let's see. That means 24,800 plus 9,000, which is 9 is negative, plus 13,000 gives us the net cash, which is the total cash, 28,800. Okay, that means just want to type for you 24,800 plus 9,000, which is with the negative one comes, and plus the 13,000 cash from financing equal to 28,800. Here is, look at this one. And we have a cash at the beginning of the period, which was equal for 2,430, and the cash at the end of the period will be 31,230. This is the plus. That means cash 28,800 plus 2,430. The cash at the beginning of the period, we have some balance, which is a positive, and it will be equal to 31,230. We have a cash in our accounts. Just a moment. Cash in accounts positive, right? Look at what I have been typed. So we have been looked at the cash flow statement from the three kinds of activities: operation activities, investing activities, and from financial activities. So any questions related to the cash flow statement? Because after that, we'll give you some kind of practical exercise based on the cash flow to prepare the cash flow. Some of you asking that, okay, why is we have some of you asking why we have a positive cash flow 24,800. Okay, this is a simple mathematics. 83,000 plus 56, but we have a 56,000. Oh, sorry. Which is a negative, right? 83. Here is just mathematics. 83 minus 56 will be 27 plus 250 plus 500 minus 500 minus 2,450 will be 24. Okay, just one more type for you. You just get your calculator and you can let's say you can hello, you can calculate yourself. Just a moment. Can you hear me? Because some of you can't. Okay. Yeah, already typing for you the explanation for these things. So you must remember that sometimes we have a cash flow negative, sometimes we have a cash flow positive. Okay, just a moment. I'm going to just show you some calculation. Just wait for me. I know the class would be end sooner, but we have a lot to do. I think we have the 10th session on the finance class. I have to say this is not enough for finance class. It's really not enough with the practical exercises. Maybe we will get some additional classes for the practical exercises. Is it okay for you? Because before the exam doing, you must be able to solve the assignments yourself. Okay. Okay. Curious. So I think I asked the VS administration to check some additional the additional sessions for the finance. Exactly, I think for the practical exercises, we need it actually. So let's see. I just typed for you the amount, the calculation of the cash flow, how it been done based on the statement. You see, 83,000 plus, which is a negative, minus 5,600, and so on. If you do this calculation, or just in your calculator, you will get the correct answer with the cash at the end of the period, 31,213. Okay. Okay. It's already 8 o'clock. We have a class for 2 hours. You see, when we do some practical exercise, the time goes very fast. Oh no, of course we need some additional sessions. So I think I will ask it for you. Try to arrange the time for additional classes. Okay? So, okay, thanks a lot for classes. I hope you do understand the cash flow statement. After the session, we'll send you all this presentation based on the cash flow statement, based on the exercise number 4 with the answers, and give you a new homework assignments. Okay? So thanks a lot. See you on the next session. Goodbye.